Guys, I've got to be honest with you. The stock market, it's overvalued. How do I know? Let me show you. This is a text I received from my mom about buying GameStop shares. We're in trouble. Come on, even my mom knows that stocks only go up, right? I'm sorry, Mom, I didn't mean to make you the butt of this joke. I just thought it was really funny. I love you. Okay, let's get real for a second here. It seems like in today's current market environment, you can buy literally anything, pretty much almost anything, and it'll just go up in value. I mean, it's getting pretty crazy out there. But my mom wanting to buy into meme stocks is not necessarily why I think the stock market is overvalued. I think the stock market is overvalued because according to pretty much any metric you could possibly look at, the stock market is overvalued. So let me show you some of those metrics, and then we'll talk about why the stock market might actually be overvalued. Like, what's the underlying mechanism here that's causing these valuations to rise to such high levels? All right, so the first metric I want to show you guys is the classic PE ratio. So this is the price to earnings ratio. And for those of you who are new to investing, this is a very classic and important ratio to investing because it's a very easy way to get a kind of a quick gauge of how expensive a company is relative to their earnings. So basically what I mean by this, and the easiest way to think about it, is how much money do you have to spend to buy a share of a company relative to how much money they earn? So if a company earns little amounts of revenue, but their shares are very expensive, so the company is very, very valuable, then you could say that that company most likely has a high price to earnings ratio because it is expensive to buy a share of this company because they're valued very highly, even though they earn a small amount of revenue. And generally, we use this kind of ratio to tell us if we're getting good or bad deals on the stocks relative to the amount of money that this company actually earns. A really easy comparison to show you how price to earnings ratios can be different between companies would be to compare something like Tesla versus a bank stock. So Tesla has a price to earnings ratio of somewhere over 1,000 last time I checked, whereas JP Morgan has a ratio of around 15. So there is a massive, massive difference there, and it's quite obvious that Tesla is a way more expensive company relative to the amount of money that they actually earn. But here's the thing, price to earnings ratios can be so different between companies because of a few things. The first thing is that they tend to be very different across industries. So Tesla is a growth company. They're very focused on the future prospects of how they're going to perform. But JP Morgan is a very safe, stable bank. They're not really looking to grow too much or innovate, at least not on the level that Tesla is. So that's why their price to earnings ratio is much lower. And another thing too is that price to earnings ratio is backwards looking. It only takes into account the earnings that the company has experienced so far. It doesn't look into the future to see if that company's revenue might grow. So that's why, while it is a really classic and pretty good way to get a quick gauge of how expensive a company might be relative to their earnings, it's kind of not the end-all be-all of valuation metrics, and you shouldn't base all of your decisions just off the price to earnings ratio alone. But the really cool thing about the price to earnings ratio is that if we want to ask the question, is the stock market as a whole overvalued? Well, we can actually find the price to earnings ratio of the entire company as a whole. So that's what we're going to look at right now. So here we can see the ratio for the S&P 500, which is one of the most common ways to track the American stock market, going all the way back to 1870. So we can clearly see that the current PE ratio of the market is quite high, and in fact has only ever been this high just before the dot-com bubble in 2001. You can also see a massive spike around the Great Recession of 2008-2009, but that was more because of companies having zero revenue suddenly, so I'm not really gonna get into that. That was kind of a weird anomaly in the data. I wanna focus more on the similarity between the dot-com bubble and today. So what happened around 2000 was there was a ton of demand for these new internet companies that were going to be the future, right? Everyone was so excited about them and just had to own shares in these companies. So this massive demand bid up the prices of these companies' shares. But here's the thing. These companies either weren't earning any revenue or they only had a very small amount of revenue. So people were paying a lot of money to invest in these companies relative to their earnings. And that's why we saw such a big jump in this price to earnings ratio of the market at that time, similar to what we're seeing right now. And as you may know of the dot-com bubble, it didn't end very well. Now we can actually take the price to earnings ratio one step further and we can look at the Shiller price to earnings ratio. This is like the price to earnings ratio 2.0, a little new and improved version of it. It was created by Robert Shiller, who is an absolute legend in the investment world, and one of his books that he most famously wrote was Irrational Exuberance, which definitely applies to today's video. But basically he created this ratio to kind of smooth out the business cycles that businesses experience when their revenues kind of go up and then they come down and they're kind of on a little bit of a cyclical path like this. So he created this new ratio to adjust for that cyclical experience that businesses have. So it kind of smooths out the price to earnings ratio a little bit more. So it's supposed to give us a more accurate picture of what the real price to earnings ratio should be of the market. And as we can see, we are still looking pretty hot here. The only time we've ever been above this point was the height of the dot-com bubble once again. Okay, so we're 2 for 2 in terms of valuation metrics screaming overvalued at us. Now let's throw a third one into the mix to see if anything changes. And the third one we'll look at is the Buffett indicator. This is something that Warren Buffett once said was his favorite way to get a quick idea of whether the stock market as a whole was overvalued. The way it works is it compares GDP to the growth of the stock market. So in other words, we're basically comparing the kind of real activity of the economy, the real output of the economy versus what's happening in the stock market. Now, the economy and the stock market are definitely two different things, but they should usually be at least fairly related to one another. So let's take a look. Wow, okay. This one looks like the worst one out of the bunch. We're sitting at a stock market that is around 221% of what GDP is worth. That is way higher than the dot-com bubble and way higher than any point in history. So according to these metrics and pretty much any other metrics you look at, the stock market is pretty overvalued relative to earnings, relative to the economy, and relative to history. And if history is any guide, it usually tells us that these types of situations don't end up playing out very well for the stock market. But there is a big reason why valuations might be so high at this particular moment in time in the stock market today. And no, that reason is not because my mom wants to buy GameStop shares. It's because of interest rates. Check this out. When we line the Buffett indicator up with interest rates, we see that rates have gone way, way, way down while the stock market has gone way, way, way up. But why does this happen? Well, imagine yourself. You're looking for somewhere to get a good return on your money. So you might look at something relatively low risk first. So maybe you look at a savings account and you see that, I can't get a very good interest rate on my savings account right now. It's like less than 1%, sometimes even a lot lower than that. So that's not very good. I don't want to just park my money in a savings account. What about bonds? Bonds should at least give me a bit better of a return. But then you look at bonds and you see that, hey, these aren't returning very much money either. So after a point, you kind of reach the conclusion that the only place that you can possibly park your money to get a decent return is in the stock market. So you have a situation where anyone who essentially doesn't want to lose money to inflation and actually wants to make a little bit of money over and above inflation has to invest their money in the stock market. So you're essentially propping up demand for the stock market as a whole. But then it creates this weird paradox of a situation because you're like, okay, if I want to get a return on my money, I have to invest in the stock market. But, excuse me.
You said excuse me.
Uh,
You're gonna leave that in there?
Maybe I will. You're like, I have to invest money in the stock market, but the stock market is really overvalued, so I feel like I'm kind of investing my money into a bubble right now. But I have to invest in the bubble because there's nowhere else for my money to go. So it's this weird paradoxical situation. And on top of that, the infamous Fed, the Federal Reserve, has basically communicated to investors and market participants that they're intent on keeping interest rates low for a very long period of time, which is going to create this environment essentially for the foreseeable future. So it's weird, guys. We're in a really weird spot. The stock market is definitely very hot relative to, again, history, the economy, earnings, all this stuff. But at the same time, it doesn't really seem like investors are going to be going anywhere else because there's nowhere to go. So if you look at it that way, it doesn't necessarily mean we're in a stock market bubble right now, because investors probably aren't going to be pulling their money out anytime soon because there's nowhere for it to go. So I definitely want to say that while valuations are certainly high, I am by no means saying that the stock market is going to crash or anything like that. I have no idea. What I do think is that we'll probably see a good amount of volatility in this type of environment. The stock market is extremely unpredictable, and remember that the data clearly shows that trying to time the market, trying to anticipate when it might drop and trying to buy in at the right time or sell at the right time is very hard to do in practice. And I think Peter Lynch definitely kind of encapsulates that wisdom in one of his great quotes, which goes something along the lines of, I'm just paraphrasing here, but something like, more money has been lost waiting for corrections than in corrections themselves. So if you're thinking about taking your money out and putting it on the sidelines, just keep in mind that we may not drop and you may lose out on the gains as this thing just keeps chugging along. I know it seems like it can't just keep chugging along, but that's what people have said countless times in the past too. So my personal kind of 2 cents and what I'm doing right now is I'm keeping my money invested. And if you're wondering how to invest in markets like this in a little bit more detail and you want to know exactly how I'm handling this situation, well, stay tuned. Make sure to subscribe because I'm going to be releasing a video on that exact topic very soon. And if you're new to investing and you'd like to help support the channel, check out the link down below to sign up for Webull, where you can get 2 free stocks with one of those valued up to $1,600 when you deposit $100. Some nice free money for you. And also, if you're a Canadian, check out the link down below for Wealthsimple Trade, where you can also get $10 when you deposit $100 after signing up. Thank you all for watching. Sorry again for making a joke about that, Mom. Love you, and I'll see you guys again soon.